What's up, everyone? It's Dividend Grinder coming to you at a Sunday. Today's August 4th. So, if you follow me on Twitter, which is at Dividend Grinder, you would see this video coming today. I've essentially created a benchmark pie to see how my individual stocks do. So, you're looking at the portfolio right now, and you can see that there is a new holding, but I didn't really add money into it or anything. I just traded out the Vanguard short-term treasury bond ETF for this CEF high yield benchmark is what I'm calling it. So before I get into the pie, let's just give a little bit of preference to this. So if you listen to my podcast, you realize, that I gave a lot of mental thought to, are you better off doing pure blue chip dividend growth investment stocks, or are you more of an income investor where you should just go for the higher yields and not worry so much about capital appreciation? I felt like that was actually one of my best podcasts that I've ever done. A lot of mental thought went into it. And that video the video podcast, whatever you want to call it, got a lot of good feedback on YouTube where people said, you make me think in different ways. And that's kind of, the way that I like looking at things. So a lot of people compare their investments to the performance of the S&P 500 or the performance of the total market index overall, something like a VOO, which is Vanguard's S&P 500 ETF, or VTI, Vanguard's total market index. A lot of people, if they pick individual stocks and not indexes, will use that as their primary benchmark, right? They'll see, are their holdings beating the market overall? Now, there's been countless times where mutual fund investors have fallen much short of what the market can do as an average. You had Warren Buffett's famous bet where he'll bet any hedge fund manager $1 million that they could not beat the S&P 500, and no one took him up on that bet. Either no one took him up or no one actually did it because they know they couldn't do it. And if anyone did take him up, they didn't beat him. So a lot of times dividend growth investors will look at the research, and there's plenty of papers out there saying that like typical dividend aristocrats actually beat out the market average. So people will look at this and say, okay, well, the dividend investing is the way to go, right? So the disconnect there for me personally, and again, this might not be the case for you. You might like the S&P as a better benchmark. But for me, I feel like personally, if your goal is to live off of dividend income, then who cares if you beat the index? Because the index is combining the dividend appreciation and the capital appreciation. So that's why dividend growth investing is so cool, because your yield on cost goes up over time, and over time the yield on cost is what makes living off dividends possible. But at the same time, if you quote unquote beat the market, it's the combination of capital appreciation and dividend appreciation. So ultimately what it boils down to is people think they beat the market, but if your whole goal is to live off the dividends, then who cares is essentially the point that I'm getting at. Because look, I'm not happy if my investments beat the market and I'm only getting like a 4% yield, because I want to live off that yield. I don't want to live off the capital appreciation. Like, that's all fine and dandy. It's good for the ego when you see the account go up and up and up. But at the same time, I'm not getting anywhere closer to my goal when I do that. So for me, I feel like the benchmark that I created here is more crucial to me, because this is, well, let's click on it. I'll show you the description of why I'm holding these. So let me just give the holdings right now. Maybe it'll be better if I go to holdings just so I can have the full name right in front of me. Oh, of course I don't see the full name. But you'll see a classic right there. Guggenheim Strategic Opportunities Fund, Eagle Point Credit Company, Brookfield Real Assets Income Fund, Oxford Lane Capital Corp, River North Opportunities Fund, Calamos Global Total Return Fund. Now, let me make this right clear. These are not holdings that I would ever advise to anyone. So why am I even using this as a benchmark? Well, in my podcast, my last podcast, I discussed how there was a fund by Seeking Alpha called the Current Income Portfolio, and it had an 8% plus dividend yield, and on an annualized basis, it beat the market in returns. And you're probably wondering, well, yeah, because it has such a high yield, of course it's going to beat returns. But the logic would say that when you have these high yielders, the capital appreciation is going to decline or at least stagnate to the point where it doesn't even matter if the yield is so high because the price depreciates so much that your annual returns almost wash or they go into the negative because the appreciation is so bad. So what the article ended up finding was that if you find out these funds that at least stay stable and they pay out high yields, then you actually beat the market. So it's kind of like inverse thinking to how a dividend growth investor does their strategy because let's be honest, a dividend growth stock, like a blue chip dividend growth stock, one that's been around for years and it's paying increasing dividend over years, they're going to go up in price because they're solid companies. Everyone knows they're solid. They do good in good markets and in bad markets because people flock to the dividend in bad markets, and then in good markets, their business, their just overall revenues increase. They're able to go into a lot more debt because debt is cheap. It's just when it's in a good business cycle, they have opportunities for more ventures. But do you really care about that stock appreciation is what I'm getting at. So reading that article on Seeking Alpha's core income portfolio kind of like opened my eyes. I'm like, wait a minute, like the whole point of me, the reason I'm called Dividend Grinder is for the dividends, for the income, for the distribution yield. So I'm not saying I'm completely going against blue chip stocks or anything like that. I would always advise people to go to blue chips or just go into index funds. Just get the market overall. That's what I would always advise people. I'll never tell anyone to go this route, but I discussed in the podcast that, my 401k is kind of my safe haven net basket. I have in such conservative holdings. I've maxed out my emergency savings. I've pretty much maxed out my 401k. I'm really safe on the back end is what I'm saying. So it's like, if my whole dream is to live off dividend income, then I should probably go for it. So what is the description? The description of this is really important. So it is the highest closed-end fund monthly yielders returning a minimum of 7% annualized returns since inception while having no distribution cuts. So this would be if I didn't care about research at all, and I just looked at the overlying theme of what I invest in. It's nice annualized returns, but having a high yield. And it's also, they had no distribution cuts, so they didn't decrease their payouts all the time. So what's interesting, if we go to research here, and we go to my pies, and then we click on this pie, you're going to see something it's extraordinary. Do I have to click into, I believe I do. So we click on that, and then we click the CEF High Yield Benchmark, and you'll see, look at that dividend yield, 12.2%. Ignore the expense ratio because we're just going for income, so it doesn't really matter. So you might be saying 12.2%, that's really unsustainable. But at the same time, you combine these six, and they've had 7% annualized returns since inception. Which means, yeah, the yield is a little high and the appreciation is not that great, but at the same time, you're getting almost the same average returns as the total market itself and all the blue chip good companies. So what I'm saying is you're getting this absolutely extraordinary yield while holding these funds that no one ever talks about, no one ever invests in because they just look at the dividend yield and they assume it's garbage. Now, a lot of times I do the same thing, and if you look at these, a lot of them I would say like they're not exactly the best, but at the same time, does that really matter if the annualized returns are the same and you're getting way closer to your goal of living off that income? Would you rather have something like a Guggenheim where even if it pays return of capital, which I'm not a fan of at all, but it helps with the taxable side because you're not getting ordinary income, you're just lowering your cost basis. Is something like that better for you if the appreciation remains flat? You get that nice juicy yield that it pays off. You're closer to your goal of living off that income, and everything's right with the world because the annualized returns are just as good as the market. So it's just something to think about, and this is what I'm going to be using as my benchmark, and it's going to work out very nice on M1 Finance because this is one of the rare times where the money weighted average works out better because I can click on this. And then when I go to gain, I'm going to see both the capital appreciation versus the earned dividends right off the bat. I can just click right under this gain, and it's going to show me because theoretically, with a 12% yield, the earned dividends should be way higher than whatever gains I have. And I'm kind of expecting the gains to be a little bit negative, and then the earned dividends are so high that it essentially washes to a 7% annual return. So there's only $629 in this. I'd like to get it to $1,000 just because that would be pretty cool, because the 12% return would amount to $120 a year or $10 a month. So look, like, I don't plan on making this like a huge staple in the portfolio or anything, at least not yet, wink, wink, but it'd be really cool to just have $1,000 in this, and I already get $10 a month. These are all monthly payers. To get $10 a month from this benchmark that I'm using. So the whole point of it is to see, look, are my individual investments, my individual choices, going to beat this benchmark, which is like, let's be real. If I put let's theoretically say I had $32,000 in that, and then I had, it was like a 12.1% interest yield or dividend yield, right? That comes out to $3,872 a year, which is $322. So imagine if I put all my money into that. The cash flow challenge, which I'll be doing tomorrow, is $500 a month, right? And right now I'm at just under $150. If I just did it into this kind of benchmark portfolio, I'm already at $322. And you might say, oh, that's not sustainable, that's not lastable. But I'm much, much, much closer to my goals doing it this way. So it's just something to think about. I'm not advising anyone to do what I'm doing. This is why you follow the channel, right? It's really interesting. I make you think about things differently because, look, my goal is to live off dividend, distribution, incomes, whatever you want to call it, passive income through investments. And it's funny, I follow a group on Facebook. It's a closed group called like Retiring on Dividends. And a lot of the people that have such massive, and I mean massive dividend income, I'm talking like $40,000 to $70,000 a year in dividend income, they don't do blue chip stocks. They do these type of closed-end funds or these high yielders, and it's like everyone always negates them because it's like, oh, the holdings aren't that great. How long are they going to be around? But if you're following it, I mean, you've already reached your goal, haven't you? I mean, if I had $40,000 a year coming in passive income, I don't really care what I'm holding. I'm just so happy that I'm getting that. And yeah, I'm not an advocate for return of capital or anything like that, but I mean, that's lowering the taxable distribution rate to you. And it's something to think about, isn't it? I mean, look, I want to live off, this whole account, this Div Grinder pie, this whole cash flow challenge that I do this account on, this is my go for it pie. So I want to live off of that yield. I'm going to take a little bit more chances because I know my 401k and my emergency savings, now that I've combined with my wife, it's such a safe haven that if this account were to go to zero, this is not the end of the world at all. I mean, seriously, like, this could go to zero. I'd be very, very upset. But at the same time, this is kind of like my go for it pie. This is my home run swing pie. Go for the grand slam, bases loaded, swing for the fences. I don't care if it's a full count, you're down one run. This is what this pie is all about. I want to get that high yield. But at the same time, as a YouTube content creator, I can't consciously say to like invest in this type of stuff because it's definitely not for everyone. And they think like they're getting this high yield and they're just like, oh yeah, I'm getting this high yield, but they don't know what they're holding half the time, or they're just copying my pie and they don't know what they're investing in. They don't know the risk associated with it. They're not willing to put in the research that they get from the quarterly reports, or what type of income is coming into the account and how much you have to worry about taxation. So it's not for everyone. That's why I always advise, just do blue chips and index. If you're completely new to the market and you just want to do around the market or beat the market maybe a little bit, or if you're just interested in getting some dividend income that'll grow over time, like if this is a Roth IRA or something, then yeah, do dividend growth stocks, do blue chip, maybe not high yields right now, but down the future it'll have such a high yield on cost that it makes it worth it. That's just not what this portfolio right here is about, and that's why people love watching this portfolio, because it gets a little bit interesting. So yeah, I would like to get this to $1,000 and then just use it as a benchmark at the $10 a mark. But who knows? You know how much I changed my mind on everything. I could invest a lot of money into it. Who knows what the future entails? I'm curious to see if my own individual investments, so my Reeves Utility Income Fund, Gaming and Leisure Properties, the three indexes that I go into, and then my monthly pickings, which is like Realty Income and Stag, do they beat this benchmark that I created for myself where the yield is so high and the appreciation is not, but it still has returned 7% annualized returns. Will it beat that benchmark? So let me know your thoughts down below. And of course, if you have not tried M1 Finance and you're interested in it, you can use the referral link in the description. You sign up using that link, invest at least $100, you will get $10 for free. And you'll also help the channel. I will get $10 as well. So hope you enjoyed this video. The new benchmark that I'm using, the closed-end fund high yield benchmark. Again, it's monthly yielders that have a minimum 7% annualized return since inception, and they have had no distribution cuts since that time. I think it's a really interesting benchmark to go against, and it'll be fun to see, do I win, or does the algorithm of CEF Connect essentially win? So this has been Dividend Grinder. Hope you enjoyed this video. I will see you tomorrow for the cash flow challenge.